All right. Hi, everyone. We are live. Welcome to Market Matters. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I'm joined by our senior markets correspondent, Bob Pisani, and today we're going to be answering all of your questions about the latest stock market moves. And it seems like it's been a pretty busy week on Wall Street. Nice to see you, Bob.
Nice to see you, Katie. We're going gangbusters today. We got a inflation report, the PCE, Personal Consumption Expenditures, which is the Federal Reserve's preferred inflation guide. There's other inflation guides like the Consumer Price Index, but this one they seem very fond of. And it's moving in the right direction. Year over year price increases, ex-food and energy is 2.5%. That's heading towards the Fed's target. So overall, things are moving in the right direction. Job growth is slowing down, but not, I would say, not dramatically. So all of this is fairly good news. And this is one of the reasons that the stock market's rallying kind of notably today. So it's a very interesting, we're in a very tricky period here. The most important thing is inflation going down. So I'll give you an idea. The personal consumption expenditure, the year over year was up past 7% back in 2022, and now it's down to 2.5%. So it literally rocketed up during COVID in 2021, and now it's coming down again. That's the most important thing. That will give the Fed some cover to start cutting rates sometime in the fall. They're going to have a meeting next week. I know there's some people who say they should cut now. I doubt it. I really doubt it. So we'll see. But this is the Fed will meet again in September. It's another, one of the reasons the market's rallying is the belief that the Fed will start cutting rates in September. And so overall, we're having a good day. Look at the S&P here. The Dow's up, was up 700 points earlier. So really, overall, this is a pretty strong day.
Well, we'll definitely be watching what happens with the Fed in the coming months. First up, Bob, let's talk about tech stocks. What has been moving tech stocks recently?
Well, today it's a little more positive, but there's a re-rating going on. That's a word I use to mean that people are changing how much they're willing to pay for these stocks. So remember, stocks, there's two issues with stocks in terms of earnings. First is how much earnings they're making and whether the earnings are going up or down. In tech earnings, by and large, earnings have been trending up. That's good. You always want that. The rate of change of earnings has been slowing down. In other words, how fast are earnings going up? So NVIDIA, had a huge move up last year. Earnings went up dramatically and the price went up dramatically, but the actual earnings increases, what we call the delta, how much is it changing, has been slowing down. And that's a warning sign to fundamental investors. The other component is what we call the PE ratio or the multiple. How much are you willing to pay for a future stream of earnings? So, for example, you might have a stock that's going to pay $1 in earnings in the next year, and the stock is $10. So you are willing to pay $10 for $1 in earnings, essentially, and dividend is thrown in here as well. So the multiple is 10 divided by 1. Under certain circumstances, you may believe that that company is going to do $2 in the following year. And you might say, oh, I'm willing to pay more because I know the earnings are going to be going up. That's great. So maybe I'll pay $11. And that's how the prices go up. But if the earnings don't go up and the price goes up, you have what's called multiple expansion. So suddenly you go to $11, but the earnings for the next year is still $1. So the multiple is now 11 instead of 10. The stock is pricier. So we're getting a re-rating. And what happens in a re-rating is, I'll give you an example. NVIDIA at one point, a month or so ago, was trading at about 47 times forward earnings. So for $1 in earnings, you're paying $47 for the stock. I mean, NVIDIA is going to make more than $1, but that's the ratio. Now it's down to about 36. You see, and the earnings hasn't changed dramatically, the expectations in the last month, but the price has changed. So the multiple has come down from 47 times to 36. That's a re-rating. That's called multiple contraction. And what's happened is some people are starting to wonder, when is all of these profits in AI going to materialize? So we had this rapid move up, and the pros used to say, when you get a correction in a concentrated market, tech stocks are such a concentrated part of the stock market, you take the stairs up and the elevator down. And you see how some of these stocks have come down in the last few weeks. NVIDIA is 20% off of its highs, and it was just June. It hit highs. So there's been a noticeable correction here. So what's happened here is, and you saw this with the reaction to Alphabet's earnings, investors are coming to understand that there's still not a big payoff for this artificial intelligence infrastructure play. Remember, we keep talking about artificial intelligence is going to change the world. I think it is. But the immediate return on your investment is not going to materialize for a long time. And they said this to Alphabet. They actually went to them and said, God, you guys are spending a fortune on developing AI. And yet, when's it going to translate into profits? You're losing a ton of money. And Sundar Pichai, the head of Alphabet, basically said, well, yeah, we're going to keep spending because this is the paradigm for our generation. This is the most important thing, and we're going to keep spending. And, investors may not have the same sentiment. They may get tired. And this happened with the internet in 2000. People were spending like crazy, and suddenly people started saying, when are you guys going to start making money? And people say, well, we don't know. And some people eventually gave up on this. This is a very different situation with these tech stocks because they're very profitable now. But you get the idea. People are saying, when are you going to start making money on the AI game? And everybody says, well, gee, we don't really know yet. Well, so far, it's a giant money pit. By the way, I don't say that in a negative way. I'm a total believer in AI. I think they're doing the right thing. The question is, are you as an investor sitting there, how long are you going to wait to make money? And some people are saying, look how much NVIDIA is up this year. People are saying, I've made a ton of money. I'll take some profits now. And I think that's probably a healthy thing to do. And you see what's going on with the market here. Some of these semiconductors, NVIDIA's off 30%. I did a story on this the other day on Trader Talk, tradertalk.cnbc.com. AMD is like 35% off the highs it hit in March. Micron's 30% off the highs it hit in June. People have already started taking profits on this. That's not a bad thing. And so, I think what's happening here is very, very healthy for the markets right now in terms of the re-rating of technology.
So, Bob, you brought up AI, which leads into our next question, a little bit more on that. So what do you think is the next big thing after generative AI?
Well, remember, generative AI is AI that generates response in response to prompts. So you type in questions, and it's more interactive than, say, a Google query. So I don't know. There's a lot of buzzwords that float around that you hear. One of them is this word emotional AI. Emotional AI is the problem with this game is these machines interact with humans. So, so you ever call into a call center or you want to call in your financial, broker, and you get a robotic voice. And it's frustrating because they don't know what you want and they can't tell you're frustrated. So there's this thing, emotional AI, where they're trying to get machines that can detect human emotional states. So the idea is to make the interactions between humans and machines a lot more natural. Like, oh, I understand. Thank you. All right, let me see what I can do to help. You're talking to a machine, but it sounds like you're talking to a human. And they're better at detecting what you really want, understanding what you want, and understanding your emotional state. So, for example, when you're calling into customer service and it says, I'm sorry, I don't understand that, this is going to go away. They'll get better, and they'll get better at detecting, like, I'm really unhappy about this, and I just don't understand why I can't get any. A machine doesn't kind of understand that in an emotional way. The emotional AI will do that. Or, for example, you're trying to assess somebody's mental state in a diagnosis, and they're calling in, and you're dealing with a robo doctor. Oh boy, you better be careful here. You better understand this person's emotional state. And so emotional AI will do that. I don't know if this is the next big thing, but this is a word that's being thrown around a lot. Emotional AI, machines that kind of have human feelings. Okay, I know it sounds ridiculous, but I believe it's coming. It's not phony. It's coming. The question is, how can you manage that transition period? Whatever it is, it's going to be better than calling in and talking to a robo machine now for anything. They're awful. So anything's better. Another thing, a buzzword is spatial computing. This is basically just augmented reality. So you're merging the physical and the digital world. So here I am. I'm sitting in my house, and imagine the sensation of you being able to strap on goggles and having sensors on your hands, feet, and have the sensation of you sitting actually right here next to me. So right now we're looking on the screen at each other. It works. We can do it. But if you want a more sensory experience, spatial computing is where everybody's going. Apple has got a device out that will do this now. Some people like it, some don't. Some find it very disorienting. But it's basically merging the physical and the digital world. So there's two buzzwords that are around: spatial computing and emotional AI that are sort of being touted as the next, big things. But all of them are powered by AI.
So, Bob, we are more than halfway through the year now. Where do you see the market at the end of 2024?
I don't do prognostications. I think the reason I don't is, first off, nobody's any good at it. So I think you, as a viewer of this stuff and a consumer of financial information, should not base your investment ideas on what anybody says. Nobody knows what the future looks like. I did 2 chapters in my book about why the future is so unknowable. Everybody is awful at the prediction business. Amateur stock pickers are terrible at picking stocks. Professional stock pickers are terrible. Professional strategists and analysts are terrible at predicting where their stocks are going to go. The Federal Reserve has the finest financial brains in the world, the best. They are terrible at predicting where the GDP of the country is going. They're terrible at predicting inflation trends 1 year out, not 5 years. Forget 5 years, just 1 year. They're terrible. And the head of the Federal Reserve, Jay Powell, has admitted this. He said anybody who's a forecaster has to be very humble. So I don't think it's very useful to go making predictions. With that said, I am personally, this is just my observation, reasonably optimistic. The Federal Reserve has pulled off a very improbable feat. There is a soft landing occurring. Now, it could turn into a harder landing, but as of now, everyone was wrong. Everyone 2 years ago believed that suddenly we were going to have some imminent recession, and that has not happened. Everyone was wrong. And if you are not noticing this, that all the pundits were wrong, you're not paying attention. This is what I'm telling you. Nobody knows nothing about the future. So what I tell people to do is what the pros do, which is have a plan to stay in the market. Don't time the markets. Don't say, I think the market may be down 2% more or 5% in the fall, so I'll wait until the fall. Bad idea. We can talk about this later, but don't. So I generally think that the Fed is modestly achieving a soft landing. I think interest rates are slowly moderating, coming down. I think as we saw from the PCE numbers today, inflation is coming down. If you ask me what I worry about, what's a risk to the market right now, earnings guidance, it's a little choppy so far. We're not quite halfway through, but depending on who you talk to, a lot of the consumer companies have been fairly weak. Consumers have been pushing back against price increases. That's good news because that's what brings inflation down. When somebody says, your chocolate bar at $1.25 used to be $1, thank you, I'll pass on your chocolate bar. They noticed that. McDonald's came out and said, people are passing. They're mad at the price increases. We're now going to do value meals at $5. That's the biggest fast food company in the world said, people are pissed off about the price increases. That's how you get inflation down. You got value meals. So I think that's good, but it puts pressure on the McDonald's. It puts pressure on them because it compresses your margins. You don't make as much money on a $5 value meal. Think about it. Well, I don't have any sympathy for, fast food restaurants. I have more sympathy for people who are out having to pay a lot more because food inflation went up. So food inflation is now moderating, which is very good news. That's great. So that's one of the reasons I'm optimistic. I'm also optimistic that tech stocks aren't going to go to the moon and be 90% of the S&P 500. It's kind of crazy. It's good that artificial intelligence has the potential to change the world. I don't want to see such a high percentage of tech stocks in the S&P 500. So we have been talking about this long-awaited rotation where suddenly, smaller stocks would outperform, and suddenly value stocks, tech stocks are growth stocks. You buy them because you think the earnings are going to grow. But there's very large swaths of the market that are called value stocks, which are generally cheaper. Their earnings are not growing as much, but you buy them because the price can appreciate because they're cheap. NVIDIA is not cheap. It's by any stretch, it's extremely expensive. Well, there's opposite ends of the market. So this month, we've been seeing this. The S&P 500 is flat this month, but the Russell 2000, which is the measure of small caps, it's 2,000 small cap stock, is up 10%. Small caps are outperforming it's been ages. And value is up this month. Cheap stocks are up. Growth stocks, like tech stocks, generally are down. This is great. This is called rotation. This is what you want. You want a healthier stock market. You don't want everything dominated by technology stocks. It's ridiculous. So that's another reason I'm a little bit optimistic. All this is good news. If you own a small cap fund, or you own a value fund, or you own a small cap value fund, hey, guess what? You're doing pretty well for the first time in a while. So everybody wants to know, is this going to last? Well, maybe, maybe not. One risky thing, traditionally small cap stocks do well off of economic bottoms. This is not an economic bottom. This is almost the opposite of that. So the skeptics out there are screaming about it. But small caps have underperformed for so many years. They're so much cheaper that I can't imagine it's time. If there's anything in the stock market that is real, it's mean reversion. There's a tendency for things to go back to the norm. This stuff has been so distended for so long. Big growth companies like tech stocks have been outperforming everything else that it's time for a little bit of mean reversion. So that's one of the things. I gave you several reasons. I'm reasonably optimistic. Now, remember, because I'm a long-term buy and hold kind of guy, and I mean, 30 years I've been doing this, and you know what I own. I own index funds. I own the S&P 500. I own a small cap fund. I own an international fund. I own bond funds. I own index funds. It's all in my book. You can read it. There's a chapter on what I own. I'm one of the few people that tell you what I own. But long-term buy and hold is a lot saner way to go, and you don't have to make yourself crazy.
So, Bob, our next question is it a good time to buy S&P 500 ETFs?
Oh, well, that kind of dovetails with what I'm saying. So we've discussed this before. Again, I don't give advice on buying and selling. I'm going to tell you what the professionals tell you. If you are 30 or 40 years or 50 years old, don't worry about figuring out if the markets are going to be up or down 6 months from now. You're going to drive yourself crazy. If you're intellectually interested in it, and that's why I'm at CNBC, because I'm intellectually interested. This is what we do all day long. We debate this, but don't worry about whether the markets are going to be up or down 6 months from now. If you're asking yourself, oh, gee, maybe I could buy in lower price 6 months from now. Bad idea. Don't time the markets. Market timing is when you think you know when to get in and get out. You don't. You have a long-term plan. That's what you need. How much are you comfortable investing in the stock market? Suppose you can save, pick a number, $500 a month. Are you comfortable putting that all in the stock market? If you're 30 years old, you ought to be, by the way. Do you only want to put half of it in? The idea is have a plan and invest on a regular basis. And don't worry, it's not going to matter if the stock market if you have a 30-year plan, it's not going to matter if the stock market is down this year. Believe me, it's not. The stock market tends to go up long term, and unless capitalism, as we know it, is going to go away, and I would not bet on that, long-term buy and hold is the way to go. There's an old saying around the pros, it's time in the markets, not timing the markets that matters. Time in the market means you stay in the market. You can, if you want, look at my book, but there are studies that indicate that most of the gains in the stock market occur on a handful of days every year. Only a handful. Here's the problem. Nobody knows what those days are. You don't, your advisor doesn't, nobody knows. So if you're not there in the market, you don't get those gains. So this is a simple argument for time in the markets, not timing the markets, not, oh, I'm waiting until the fall to get in because it's going to be 5% lower. You have no idea whether that is happening. I'll give you one final analogy. I have a friend, Charlie Ellis, who's very famous in my business. He is a financial analyst and planner, and more than 30 years ago, he wrote a very famous book called Winning the Loser's Game. He talked about tennis as an analogy for stock investing. Pro tennis is a winner's game. In pro tennis, the purpose of the game is ball precision. As a professional tennis player, you want to put the ball in a certain part in the court where your opponent is not. So in professional tennis, ball control, put the ball where your opponent is not. Amateur tennis, so professional tennis is a winner's game. The person playing can control the ball and put it where it's not for its opponent. Amateur tennis is the opposite. It is a loser's game. In amateur tennis, most of the time, your opponent loses because they're unable to get the ball over the net, because they're not professional enough to return the ball. So therefore, the correct strategy in amateur tennis, because you can't control where the ball goes, is simply, because you're an amateur, it's simply get the ball over the net. You don't have to worry about where the ball is going on the other side. Your opponent is going to make the mistake because they have a high probability of not being able to get the ball over the net. So in the loser's game here, the way to win the loser's game in amateur tennis is just get the ball over the net. The analogy with professional stock picking is don't think you know when to go in and go out. Simply get the ball over the net. And the way you get the ball over the net is just stay invested in the market. I would advise you, if you're really interested, Winning the Loser's Game by Charlie Ellis is a very, very famous book explaining all of this and explaining about, probability theory and, investing in the stock market.
All right. And Bob, our last question for today is about the IPO market. So will we see more IPOs this year?
I'm eternally optimistic. I cover IPOs. I've been doing IPOs for 25 years. You know me. I'm eternally optimistic about these things. But I have been optimistic for 2 years, and basically it hasn't happened. We had a great IPO this week. Lineage came. LINE is the symbol. This is the biggest refrigerated storage REIT in the world. They raised $4.4 billion. That's a lot. I mean, a typical IPO will raise 100 to 500 million. 4.4 billion is a lot. And it's the biggest IPO, in almost a year. The last big one was Viking, and they only raised 1.8 billion. So what do they do? We had the CEO on, and somebody said to him, well, explain simply what you do. He said, you ever have sushi in a restaurant? It's been in our warehouse. So they ship food. They refrigerate food so it can be moved. All this fresh food that you get around the United States, it's in a lot of their warehouses. And that's how they move stuff around. It's a great company. And it's done well. They priced more shares than they thought, and it's been trading well. So even with that, though, and I did a story earlier, earlier this week, we've only priced about $21 billion in IPOs through 7 months. In a normal year, you do about 50 billion in the full year. This is the third year in a row it's been subpar IPOs. And the reason this is happening is not because the stock market is terrible. Remember, we're at new highs. I often say the most important thing on the IPO business is how the stock market's doing. And the stock market's doing fine. Interest rates are moderating. That's good too. So you can't say, oh, I don't like the stock market. It's a valuation problem. It's the same thing that happened with these tech stocks. It's not the markets. The problem is the public investors are not willing to pay valuations in the private market. So these tech companies have stayed public, and they have venture capital. And the venture capital people are throwing money at them, and they're getting new rounds of private funding at estimated very high valuations. So you have these private companies that, let's pick a number, it says they're worth $5 billion. And then all of a sudden they go to the public market, they go IPO, and they issue a certain number of shares at a certain price. And it turns out that the public valuation, instead of $5 billion, is $3.5 billion. Well, that's called a down round. You're going public, but at a lower valuation than you had when you were private. And that reason is the public market pushes back against the high valuations. This has been a consistent problem for at least a year now. And I don't blame them at all, because we've consistently had IPOs that have come out. They have a one-day pop, and then a few months later, they're down. So the poor people who buy this stuff in the public market on the first day, they get killed eventually. And the people who are, IPO buyers eventually push back. So this is a problem. If you're a tech private company, you could do one of two things. You could say, well, crap, I don't want to take $3.5 billion. I want to, let's just stay private longer and hope maybe next year we'll get a higher price if we go public. Other people don't have that luxury. They're out of funding. They need more money. They can't get private equity money anymore. Their employees want a better cash out way and going public's the way. So they'll have to take the $3.5 billion. Hopefully there are enough companies that are willing to do that right now. That's really the game. What kind of valuation do you think you have, and can you afford, if you don't like it, to stay private? I am very unhappy about the fact that there are so many companies staying private for so long, and the public has very little way to get at this stuff. And you see this mad dash by a lot of companies out there to figure backdoor ways to get to private companies away from the public markets. I do not think that is healthy at all. So we have to make it easier for people to go public. Maybe some people have to get over the greed that they have. Maybe their company isn't worth $5 billion. Maybe realistically, $3.5 billion is a realistic valuation. Maybe a little less greed. There's my personal observation on that.
All right. Well, those are all of our questions for this week. Thank you to everyone who sent in questions. Thank you to Bob for your responses as always. And we'll talk again in a few weeks.
Thanks, Katie. Good questions, everybody. Have a good weekend.